Have you ever wondered why two people with the same income can get vastly different credit offers? Welcome to the perplexing world of credit scores, a numerical representation of your creditworthiness that plays a pivotal role in your financial life. Every time you apply for a loan, mortgage, or even a credit card, lenders pull out this magic number to assess how much of a risk you pose. It's fascinating, isn't it? Two individuals, earning the same income, leading similar lifestyles, but when it comes to borrowing money, they're offered different terms. One might get a loan at a lower interest rate, while the other may face a higher rate or even rejection. It's not always about how much you earn, but how you manage your finances. But what's the secret behind this number? What influences these scores, and why do they differ among individuals? So what determines these scores and why do they differ? Let's dive deep into the world of credit scores. Your credit score isn't just a random number, it's a reflection of your financial behavior. Let's dive into the 5 main factors that shape your credit score. Picture these as the pillars of your financial temple, each contributing to the stability of your fiscal standing. First up is your payment history, which is quite simply the record of whether you've paid your bills on time. This is the most significant factor, making up about 35% of your score. It's like the attendance record at school. Punctuality counts. The second factor is credit usage, accounting for around 30% of your score. This refers to how much of your available credit you're using. If you're maxing out your credit cards, it can suggest to lenders that you're over-reliant on borrowed money. Think of it as a balance beam exercise where maintaining balance is key. Thirdly, we have the length of your credit history. The longer you've been borrowing, the better picture lenders have of your financial behavior. This makes up about 15% of your score. It's akin to your school's term length. The longer it is, the more you learn and grow. The fourth pillar is your credit mix. This looks at the types of credit you have, such as credit cards, mortgages, or student loans. Having a mix suggests you can handle various types of credit. It's like taking different subjects at school. The more diverse your subjects, the more well-rounded you are. Finally, there's new credit inquiries. Each time you apply for new credit, an inquiry is made, which can temporarily lower your score. This makes up around 10% of your score. It's like extra homework. It's okay in moderation, but too much can be overwhelming. So there you have it. Your payment history, credit usage, length of credit history, credit mix, and new credit inquiries all play a part in determining your credit score. Each of these factors is like a subject in school, and your credit score is the cumulative grade. Remember, your credit score is like a financial report card. And these factors are the subjects you're being graded on. Now that we understand what shapes your credit score, let's uncover some hidden pitfalls that you need to watch out for. Firstly, one common misconception is the belief that checking your credit score can lower it. This is a myth. Regularly checking your credit score is, in fact, a sign of responsible financial behavior. It allows you to spot any errors or discrepancies early and address them before they become a larger issue. Don't shy away from checking your score. It's a key step in maintaining financial health. Another false belief is that a single late payment won't affect your credit score. Unfortunately, this is not the case. Even one late payment can have a negative impact on your credit score. This is because payment history is a significant factor in how your score is calculated. So it's crucial to ensure that all your payments are made on time, every time. Now let's talk about the credit utilization ratio. This is the amount of credit you're using compared to the total credit available to you. It's a less-known factor that can significantly affect your score. The lower your credit utilization ratio, the better your credit score tends to be. This means that maintaining low balances on your credit cards can actually improve your score. So even if you have a high credit limit, it's best to use only a small portion of it. Finally, it's important to understand that closing a credit card account doesn't necessarily improve your credit score. In fact, it could potentially hurt it, especially if the account has a lengthy positive history. The age of your credit accounts plays a part in your credit score, and older accounts can help boost it. In conclusion, it's crucial to dispel these misconceptions and understand the true workings of credit scores. By doing so, you can avoid harmful financial behaviors and take steps to improve your financial standing. Remember, little tweaks in your financial habits can have a big impact on your credit score. Avoiding these pitfalls can be the difference between a good and an excellent credit score. So, we've taken a journey through the complex world of credit scores, and it's time to wrap up. We've explored the crucial importance of credit scores, the various factors that shape them, from payment history to credit utilization, and the hidden pitfalls that can trip us up, like the impact of high balances or late payments. Remember, understanding your credit score is the first step towards financial freedom. So keep learning, keep growing, and most importantly, keep scoring.